Good morning. Thank you for joining us. I'm Bob Sharon, partner and leader of the firm's tax practice. I'm pleased to introduce you to today's presenters. Tom Corey is a principal at Friedman and director of the firm's state and local tax group. He has more than 30 years of experience. Tom has worked with clients in a broad array of industries and advises high net worth individuals with respect to both their personal and business state and local tax matters. Joining Tom is Alan Goldenberg, a principal at Friedman, and he is a member of our state and local tax and our tax controversy groups. He focuses on tax transactions, including structuring, advisory tax services, and tax controversies. Alan has more than 10 years of experience representing taxpayers before the IRS and local tax authorities. Friedman is a leading provider of accounting, tax, and business consulting needs of public and private companies since 1924. We are consistently ranked among the top 50 accounting firms nationally and have ranked among the best places to work throughout the accounting industry and all regions where we operate. Friedman's State and Local Tax Services Group is dedicated to helping clients avoid pitfalls and maximize their tax position in a complex and evolving tax landscape. The goal of today's program is to help you understand Wayfair compliance and the new practices that businesses are adopting now that 43 states have implemented Wayfair economic nexus thresholds. At the conclusion of today's webinar, we will attend to questions from our listeners. You can submit those questions and communicate with us throughout the course of the webinar using the Q&A feature on the lower portion of your screen. We would also be delighted to schedule time to speak with you on a one-on-one basis to better guide you on your particular situation. And at this time, I'm pleased to turn the presentation over to my colleague who will kick off the program.
Some of the major themes from this Wayfair wave that's come about is that we're entering, as Tom said, this new world of economic nexus where it's no longer physical presence. We've changed economies, a lot of remote sales. And so that's sort of the new direction that these rules are going in. It impacts not only remote sellers, but it impacts also brick and mortar stores that will ship their product elsewhere. It also impacts wholesalers. So there's really a broad application of this Wayfair decision. In fact, as of today, 43 of the 45 sales taxing states are in fact employing some variation of the Wayfair ruling, and as a result, there's a lot of compliance. So it's currently only the only two states that don't have a Wayfair type rule or a nexus, economic nexus, are Florida and Missouri, and it's probably due to the fact that they're tied to state budgets, and once those budgets come across, they can. They'll likely update their rules such that they will enact a Wayfair statute.
Just very quickly, we understand there was a bit of an audio issue with the webinar broadcast. So very quickly again, prior to Wayfair, the Supreme Court had held in a series of decisions, one being National Bella Hess, another one being Quill, that an actual physical presence was needed in the jurisdiction before that jurisdiction could assert sales and use tax nexus over a business. And the Wayfair decision said, hey, that's not the case any longer, and it really was a reaction to the changing economy. Now we've got much more, obviously, internet sales and that type of thing, so that bricks and mortar locations and touching actual soil in the state is often not the reality of the situation. States were very upset the fact that they were losing money, and that led us to the Wayfair decision. And Wayfair, very quickly, I think Alan will touch on, was a situation where states, one of them being South Dakota, actually challenged the Quill decision by passing a law. Alan?
Sure. So in 2016, South Dakota issued a law that stated that sellers that do not have physical presence in the state will nevertheless be deemed to have nexus, economic nexus with the state, if they meet a certain threshold. The first threshold is having sales into the state of $100,000 or more, exceeding $100,000. Or the second threshold being that you have more than 200 transactions into the state. It's important to note that South Dakota does not have an income tax, so they rely very heavily on sales tax revenues to meet their annual budgets. So the concept was that not many businesses have physical presence in a state like South Dakota, so they want to try to cast a wide enough net to bring in those sales tax dollars for those out-of-state businesses. Typically, states try to push the tax burden to out-of-state businesses. It looks better politically and legislatively. So this was the concept that they came up with, which, as Tom mentioned, is in direct contrast of Quill and National Bellis Hess, which required a physical presence within the state.
The actual Wayfair decision itself, just as a brief review, was a 5-4 decision that was written. It was actually, I think, the last decision issued by Justice Kennedy that ruled that the physical presence rule is no longer required for constitutional purposes. Basically, he said its physical presence rule has become further removed from the economic reality of today's internet marketplace.
Right, and Tom, just to sort of put that in perspective, when Bellis Hess was decided, the internet didn't even exist. And when Quill was decided, less than 2% of Americans had internet access.
Yeah, Bellis Hess, wasn't that a 60s decision, Alan?
Right, so you move from those rulings and that, economy to today, where online sales, make up almost 15% of all sales within the country. We're talking about over $500 billion annually of sales. So certainly there is a void there that South Dakota identified as a place to, capture those, sales tax dollars.
One thing we should remember about the Wayfair decision is that in its the text of the decision, the justices did not define what would be constitutional or unconstitutional in terms of the amounts of sales that have to take place, the number of transactions that have to take place, and everything else. In essence, they said the physical presence requirement is not a constitutional standard any longer, but they did not define what parameters would be constitutional or unconstitutional in terms of the amounts of business that has to take place or the number of transactions. As a result, we've got certain states, and I recall, I think Pennsylvania is one of them, where they have an alternative where you may have, if you have $10,000 worth of sales, you could have economics with that state in certain situations.
Right, so what the court actually did in its ruling is they went back to the complete auto case, which was a late 1970s Supreme Court ruling, where they discussed, basically under the Commerce Clause, which types of taxes are constitutionally valid. And in that case, the Supreme Court set forth sort of four-pronged test for that. The first leg of that test was that there needed to be a substantial nexus between the taxing state and the taxpayer. Usually that taxpayer is an out-of-state business. Second, that tax has to be fairly apportioned, and there have been many Supreme Court cases on apportionment and what is deemed to be reasonable in that respect. Third is that the tax itself can't be discriminatory against out-of-state businesses. And fifth, there has to be a relationship between the taxing state and the taxpayer. In applying those to the Wayfair case, Justice Kennedy alluded to the fact that it really does meet all these four prongs, and as a result, is constitutional, and this is really the standard going forward when it comes to these types of legislation.
Alan, it's interesting to note here that Justice Kennedy was looking for some support for it, and he went to complete auto, but complete auto is an income tax case. And so in other words, he applied income. That's why you get these fairly apportioned and everything else. Income tax terminology and thinking with respect to sales and use tax, because the reality of the situation was the states were pressuring the court a lot about this. There was a lot of friend of the petitioner type briefs that were handed in, and Justice Kennedy was, reaching a little bit when he used complete auto.
So let's discuss some of the fallout that we've seen as a result of the Wayfair decision. And currently, there are 43 states, as I mentioned earlier, that have enacted either some sort of legislation or regulation, some states even just guidance by the Revenue Department, issuing an economic nexus within the state. As I mentioned, the 2 states of the 45 that currently are not, do not have an economic nexus are Florida and Missouri. Kansas, the Department of Revenue has issued guidance saying that they do have economic nexus in the state. However, they did not put forth a threshold, and as a result, there's been some back and forth with the Attorney General and the Governor as to whether that is constitutional by not having any minimum threshold. So right now, it seems like it's on hold, but in general, this is the new law of the land across state lines. Tom, you want to discuss some of the varying provisions and some of the hardships that have to be dealt with?
Yeah, we're going to talk about them, but it's interesting to note here, Alan, that the state laws vary greatly in a number of ways. And it's really, especially with smaller and mid-sized businesses, it's really somewhat of a hardship for them to keep track of all of this. Many people are trying to, frankly, activate some kind of automated sales and use tax programming and everything else. When you realize that there are somewhere about 11,000 sales and use taxing jurisdictions within the U.S., you can understand the extent of the problem. Now, in terms of the economic nexus standards, in general, they usually are termed with some dollar amount of business being necessary. Could be 100,000, could be 200,000, could be more than that, or less than that in some cases, and or a series of transactions. So it could be 100 transactions, 200, etc. There are several states, I believe, where you have end, so you have to have both the level of spending out there, the sales, and the number of transactions. And there are some situations where, frankly, how do you define, this is problematic, and we'll get into this a little later on, but how you define a transaction is a problem. Is a transaction an invoice? Is a transaction, what if I'm buying, 14 lots of items, but they're all invoiced on one invoice? Is that 14 sales? Is that one sale? Again, laws generally don't define that. The problem here is there are almost uniformly among the states there's a lack of guidance with respect to how they are going to be applying these actual different state statutes. And it's difficult to track, in many cases, the changes of them. And some states, because of the problems for instance, with the transaction definition, they are eliminating the transaction standard at all and saying, hey, if you've got $200,000 worth of sales or 100,000, whatever their threshold is into the state, then that's enough for economic nexus.
Right. Some of the states really need to look at the provisions, and not all these provisions are very detailed. Some states refer to tangible personal property as the deciding factor, whereas others, may include tangible personal property sales, service receipts, software, digital products in that threshold test. So really, because the Supreme Court did not discuss the thresholds themselves and the details of those thresholds, the states vary greatly as to how they apply these rules, and that certainly makes compliance with these rules incredibly complex.
Yeah, especially again, if you take certain states where they've got a $10,000 threshold, if you have a small business, even a tabletop type business, you can easily exceed that $10,000 threshold. For instance, in Pennsylvania, is a very big state, sales into Pennsylvania. Then you've got a situation where you've got a nexus, and you're going to have to be filing returns, keeping track of sales, and everything else. It's really problematic for these smaller and mid-sized businesses, Alan.
Yeah, and the compliance aspect is a huge burden. Some states are on a calendar year for sales tax purposes. Some are on a fiscal year. Registrations have different rules and different questions and different information that has to be provided. So there's really a lot of integration that has to be done. Businesses really need to examine what it is that they're selling versus the state rules as whether something is taxable or not taxable in a particular state. So there's really a huge onus on taxpayers to have to deal with these new rules due to the lack of uniformity across the various states. And then once you made that determination, it's a matter of keeping the proper records, ensuring that you're timely filing, ensuring that you're collecting the proper sales tax rates across state lines. So it certainly becomes rather burdensome for many businesses.
Yeah, I think we also have to face the reality that oftentimes through various industries, lobbying efforts, or the state itself wanting to push certain items in its economy, they will decide, hey, this item is not taxable, or that item is not taxable for whatever reason. And then you have, as I said, you have different items that are exempt and not, and then you have to keep track of what items in which state are exempt. You have to collect those exemption certificates, and you have to keep them on record as to why a particular item, which should have been subject to sales tax in, as an example, Wisconsin, is not subject to sales tax in Iowa. And that can be very problematic, again, for a smaller and mid-sized business, Alan.
Yeah, and part of the problem also is that one transaction can put a taxpayer over a state threshold. If the state threshold is $100,000 and there's a lease of commercial machinery, let's say, for $150,000 one time of year, that company may exceed the threshold, and as a result have a sales tax obligation in a state where they may not be continuing to do business in future years. So it's really a curveball for many businesses to have to deal with, because sales tax, and Tom can go into this more, is a responsible person or a trust tax. There is a lot of fallout for business owners and those responsible for the sales tax function.
Yeah, Alan, you touched on a good point. Depending on the law, as Alan said, you could have a situation where you have a transaction. If the state is an end state, so you'd have to have a certain number of transactions plus a certain economic threshold that's passed. If you have a transaction, let's say, where the economic threshold is $200,000, and you have to have 100 transactions, but you have one transaction, it's a $500,000 transaction, you haven't established economic nexus in that particular state. On the other hand, you could have a state where you have an or situation, 500,000 or 100 transactions, and you would have economic nexus. So the same transaction can have very different results depending on the particular legislation of the state involved.
So I think states have become somewhat aware, and there's been an uproar from a lot of smaller businesses, particularly those that are selling their items over the internet. Think about vendors over Etsy and third-party sellers over Amazon and Walmart Marketplace. So what states have started to do is introduce a marketplace provider or marketplace facilitator legislation. And in essence, what that does is it shifts the compliance burden from the third-party vendor or seller to the marketplace. So rather than receive thousands and thousands of sales tax returns, the state would only require Amazon, for example, to file a sales tax return encompassing all of the sales into the state done through its platform. What that has done is it allows the state a little more breathing room when it comes to auditing for those sales, verifying those sales, and ensuring compliance by a broader range of taxpayers.
An interesting problem, which is really not an economic nexus problem with marketplace facilitators, is the fact that, generally businesses turn over inventory to an Amazon or another facilitator, and they expect that inventory in general is going to be kept in one or two, maybe two warehouses. But the marketplace facilitator, for its own ease and of shipping and everything else, may spread that inventory over a number of states without, frankly, the direct knowledge, at least initially, of the business whose products they are, the sales of whom they are facilitating. So all of a sudden that business finds out that it has inventory, actual physical inventory located in 10 states or 12 states, and when they thought they only had, a couple of states to worry about. That, of course, having physical inventory in a state, absent economic nexus issues at all, gives the standard physical presence inventory, a physical presence nexus to those businesses. And we found that in many cases with some of our clients.
So in addition to that issue, Tom, there are still questions because the marketplace provider rules are so new. 40 states have such legislation out there or guidance put out there, but there's not necessarily uniform definitions of who the marketplace provider is, what qualifies as a marketplace provider. It's obvious in some cases when we're talking about, eBay and Amazon that they certainly are the type of platform that would qualify, but there are smaller, online software provider platforms, for example, that do those qualify, do those not. So there's certainly things that still need to be contended with, and definitions still need to be, further expanded upon to see who in fact falls within the marketplace provider rules. Another thing, just carrying on with Tom's concept of the inventory being moved all around, it could also become somewhat problematic in dealing with these third-party sellers, right? Certainly the sales through the marketplace providers would be taxed, but what about their sales that aren't through the marketplace provider? Say they have their own website and shipping inventory from a separate warehouse. How does that impact? Are the sales of both the online marketplace provider and their own sales combined to determine if the vendor does in fact exceed a state threshold, or are they looked at separately? So these are all kind of newer questions that have popped up as this new guidance has come to light.
Alan, kind of an interesting result from Wayfair decision is the expansion of the Wayfair concept, this economic nexus, again for sales and use tax purposes, concept into the income tax area. Now there were many states, I wouldn't say many, but a number of states beforehand that had branched off into the economic nexus for income tax purposes, but there's been a stimulus in the states by this Wayfair decision. You want to expand on that a little bit?
Yeah, so really Hawaii was the first state to jump on this bandwagon, and that was to take the Wayfair standards and bring them into the income tax form. So what Hawaii has done is starting on January 1st, 2020, businesses with over $100,000 of sales or 200 transactions, either in 2020 or the previous year, in 2019, will be deemed to have economic nexus for its corporate income tax. So they've done this, and now we're starting to see this sort of morph into various other jurisdictions. Recently, Massachusetts came out with some guidance saying that $500,000 of in-state sales is enough for corporate excise tax nexus. Pennsylvania similarly put out a notice saying that there's a presumption of nexus if receipts in the state exceed $500,000. So I think that there's going to be a growing trend here that we're going to see more and more states picking up on this as a way to not only collect sales tax, but also now collect income tax dollars from various jurisdictions. Now, I think the one thing that's important.
Hey, we need to remember, and there is in the slides, it should say Public Law 86-272. It says Public Law 86-292. Apologize for that. But in any event, Public Law, just as a reminder, Public Law 86-272 was a law enacted by Congress, I think it was in the late 1950s, way before the internet type marketplace, and really was geared to protecting out-of-state businesses who may have sales into a state from establishing nexus in that state. And it only dealt with basically tangible personal property and taxes that were based on net income. So in 86-272 says, if I am a business and I send sales folks into a jurisdiction to solicit sales, and that's all they do, and those sales have to be approved out of state, and the products are shipped in from out of state, generally by common carrier, and there is no other services. In other words, they're not collecting on invoices or anything else, then that is not sufficient to give income tax nexus. Some of the states, you'll see Oregon here is a new gross receipts tax. Economic nexus, Public Law 86-272 does not apply to non-income tax-based taxes. So in this case, the gross receipts tax, Public Law 86-272 will not protect an out-of-state business from that. The other thing is that even though you've got some businesses, some states that are implying income tax economic nexus rules, 86-272 trumps the state's law because it's a federal law.
And I think one other item from the income tax perspective that should be pointed out is that most states have different rules when it comes to sales tax nexus and income tax nexus. So it is possible to be filing a sales tax return in a state, but not necessarily an income tax return in that state. And as a result of this Wayfair rules now that we're seeing states put out, I think we're going to also start seeing more and more audits by states for taxpayers that are only filing sales tax return, but not an income tax return. And the states will certainly do their best, assuming they haven't enacted Wayfair for income tax, to try to bring in those out-of-state taxpayers and deem their activities in a state to be enough such that they also have income tax nexus. I think that's something that certainly businesses need to Tom, you want to jump into some of these issues that we're seeing with our clients and you know, some of the things that have to be contended with going forward?
Right. Some of these issues are, you know, really worrisome and troublesome to our clients. Obviously, how will these Wayfair rules be applied retroactively? Are the states going to apply them only prospectively, or are they going to go look back? We've had guidance from some states that say, hey, as of such and such a date, we are going to be looking to apply economic nexus. On the other hand, we have had some states that say, hey, we're going to go back to previous years because we think that really the Quill decision, the Quill standards were, unconstitutional way back when. How much leeway will be given to businesses who delayed registering or filing? Are their feet going to be held to the fire, or are they going to be subject to, serious penalties?
Yeah, and I think each taxpayer needs to, assess what their exposure may be, and based upon that, determine, which states should they be filing, and what states maybe are they approaching a threshold, and therefore need to certainly consider that. For the most part, I think states are still focusing in on getting businesses registered under these rules. They understand that this is new, and certainly it's difficult for many smaller businesses. But nevertheless, there needs to be an ongoing monitoring by businesses, and they have to determine at what point have I reached my tolerance that I need to start filing in a particular state. So certainly it's burdensome. Again, each state has different registration requirements, and each state, has different thresholds. So once we get into that, level of detail, there's a lot of decisions that need to be made.
One of the things that is troublesome, of course, about these economic nexus standards and sales tax in general is this concept of responsible party. Since sales taxes are collected from the customer, business's customer, and they are held in trust by the business for the benefit of the state, there is this concept of responsible party. It's also that kind of concept when it comes to payroll taxes. But if, in fact, the taxes are not collected properly, or even worse, if they're collected and not remitted to the state, the states that have this responsible party concept, and most of them do, can go after the responsible parties in the business, oftentimes, corporate officers, or even employees that are responsible for collecting and remitting those taxes. So it's an issue that it can be quite troublesome when you talk about, attaching people's, and we have seen this, attaching people's bank accounts, going after their assets, houses, that type of thing. Very problematic.
So some of the other issues, Tom, that we're seeing with our client base that we often get asked are, what about foreign entities? And foreign entities, are also subject to the Wayfair rules. Unlike income tax, or certainly federal income tax, where there are treaty protections in place for foreign businesses, a foreign business that sells, taxable product into the state that exceeds a Wayfair statute would have the same compliance obligations as a U.S.-based company. Another thing that we're seeing is when there's businesses being bought and sold, there's certainly a greater need now for due diligence to examine the sales tax function, see where maybe there is exposure in various states where a business is not currently filing at this point. And as a result, we've seen, certainly larger escrows, to ensure that there, won't be an issue or a future problem with the outstanding sales tax. And one other thing I think it's important to point out is, financial statement disclosures. Certainly, larger companies that do have potential sales tax exposure, if it's a meaningful enough amount, that has to be disclosed on financial statements. And really that financial statement then becomes a roadmap for state auditors. They tend to read the detail, the notes of the financial statements. And if you're listing a number of states where there's potentially outstanding sales tax, state is likely to find that and pursue. So we may see an uptick then in the need to get into compliance because of these disclosures.
This concept of economic nexus, one of the issues is, does it ever end? Supposing I do business, I happen to generally do business in, 20 states, but one year I happen to go into Wisconsin. I'm not normally there. And Wisconsin, I file and collect sales taxes. Do I have to do that on a continuing basis? Even the answer is theoretically no, but if you stop suddenly, you can expect that you're going to get a knock on the door, in essence, in the mail as to why you're not filing for this particular year. And you have to be prepared to substantiate the fact that for that particular year, given the standards that, Wisconsin says are imposed as to when you cut off Nexus, that you meet those standards.
So before we get to your questions, we'll touch upon some of the best practices for a business and how to deal with these new Wayfair laws. And the first step, I believe, is to start with reviewing your current sales tax compliance. What states are you filing in? What are the products that you're selling or the services that you're selling? Are they taxable? Are they not taxable? If they're not taxable, is it due to an exemption such that you have to obtain a certificate? How is that certificate management going? States are becoming a little more aggressive in ensuring businesses have those exemption certificates on file under audit. And if required, are there any financial statement disclosures, maybe some things that need to be cleaned up, are outstanding liabilities that a business wants to address, to get them on the right footing when it comes to their sales tax filings.
When Alan and I go out to meet with clients, basically, if we see a client is only filing sales tax returns in 3 or 4 states, but maybe having sales in 20 or 30 states, that immediately triggers, questions, and we have follow-up. Often, we'll have to do Nexus studies and everything else and say, hey, maybe you need to consider filing here. This is the problem. You've got, under these new standards, economic nexus, where maybe you didn't have before because you weren't sending salespeople in. Definitely changing how you analyze where you have a sales tax footprint.
Yeah, and in that process, it requires certainly some new attention when it comes to the sales tax function. There's a lot of automated service products out there that plug in to billing systems that will compute the sales tax, that will facilitate the filing of those tax returns. And now certainly the time for taxpayers to evaluate the systems that they're using and whether they're compatible and up to speed for all these new rules. Or to consider, maybe outsourcing the sales tax function to make sure that they're, being attentive and doing the right thing when it comes to the sales tax. I think the final point also is you need to actively monitor your business, your sales, on a going forward basis. Are you filing in all the states you're supposed to be filing in? What are the new rules in the states? We're here. We are constantly monitoring every state. We are updating our internal work documents to make sure that we have the latest information to provide to our clients for this new rule, and really make sure that we're on top of any developments to ensure proper compliance by our client base. So I think with that, we can move into some questions that were sent.
We got a question here. It says, if your only retail sales into other states are through marketplace facilitators, and if those states require a facilitator to collect and remit sales taxes, does that eliminate any requirements to register in those states? I would think you have to look at the state law, but my in that regard, but my off-the-cuff answer on that one in general would be no. That I think you would have to register. Most states have some form of process where there's a cross-checking of the marketplace facilitator with respect to the active business itself.
Another question here saying, seems like states are all over the map when it comes to these Wayfair rules. Is there any unification of these rules on the horizon? And the answer is, as of now, no. 23 states are part of what's known as the Streamlined Sales and Use Tax Agreement. That they've unified their sales tax code such that items are taxable, really across state lines the same way. The exemptions are the same. They have uniform exemption certificates that can be used in the various states. So that is helpful. Do I see, all 45 sales tax states signing on to that in the near future? No, but it certainly helps when it comes to registration. You can do one registration and pick the jurisdictions where you do want to file in. So that is somewhat helpful, but unfortunately, we still have to contend with all these various states.
Alan, another question that came in is, how do you look to count transactions and determine whether you've exceeded the economic threshold when you're dealing with a wholesale retail situation? So again, just very quickly, sales tax is imposed on the final sale, the retail sale to the retail customer. Many businesses obviously ship in products on a wholesale basis to bricks and mortar stores in a location that may be selling them out to the customer. The answer to that question in most cases, although many states haven't given guidance on it yet, but what we've seen is wholesale sales count. So if you've got maybe $100,000 worth of retail sales, plus I've got $150,000 worth of wholesale sales, and the state says, hey, we've got a $200,000 economic threshold, you've exceeded it because you're at 250, even though 150 of those are exempt transactions. The same thing when it comes to the number of transactions. Generally, what we're seeing is the wholesale transactions count when it comes to whether you're equaling or exceeding the number of transactions necessary to give you economic nexus for sales tax purposes.
Another question here that says, if a business doesn't have physical presence in a state and it needs to register because it may have exceeded the Wayfair rule in that particular state, doesn't need to hire an in-state registered agent. So I think it's important to understand that for the most part, and again, we're 50 states, so these rules vary, but for the most part, there are different registrations. There's a sales tax registration, and then there's also registration with the Secretary of State, and that is to do business in a particular state. When it comes to just registering for sales tax, you do not necessarily need an in-state registered agent because all you're doing is remote sales into the state, and for the most part, the states don't require a registration with the Secretary of State. Now, there are states out there that don't have a registration with the Secretary of State. Everything is done through the Department of Revenue, and in that case, there may be a requirement for an in-state agent, but I think for the most part, it's not going to be required. Tom, I have another question here that says, my company has been out of compliance. Is there anything I can do to get into compliance, from now going forward?
Yeah, I mean, Alan, many states have what's known as a voluntary disclosure program, whereby you can go in often on an anonymous basis, at least initially, and ask to enter their, give a statement of facts, again, generally on an anonymous basis. Often third-party providers are hired to do this for a business. Ask to enter the voluntary disclosure program. If you're accepted into the voluntary disclosure program, usually what happens is all penalties are waived and you have a limited look back. meaning that it's often the current year and 3 previous years. Interest is charged usually at the standard rate, as opposed to many states have a penalty rate. Once that's done and the agreement is reached, obviously the taxpayer's business name is revealed to the state, and they go forth and sin no more, basically. States want these programs to include, to get more taxpayers on their payroll, so to speak, the tax rolls. And that's why they put these voluntary disclosure programs in place. One thing I have to say, though, if the state finds out about you before, if they approach you generally, you're not going to be permitted to go into the voluntary disclosure program. You have to be proactive in approaching the state first.
Another question here. You've thrown a lot of state information at us. Are there any states that I don't have to worry about when it comes to these Wayfair rules? So I mentioned thus far, Florida and Missouri have yet to enact a Wayfair type rule. Kansas is still grappling with theirs. And then, there are a couple of states that don't have sales tax, so you can cross them off your to-do list. Those states are Alaska, Delaware, Montana, New Hampshire, and Oregon. So if you do have sales into those states, you don't have to worry about the imposition of any Wayfair type nexus. Now, I will point out that there are certain states that have very, very complex sales tax rules. And as a result of Wayfair, it's not simply computing a straightforward sales tax rate. For example, New Jersey has one state rate, and that, once you know that rate and you've been filing in New Jersey, it's fairly easy to comply. A state, for example, like Colorado, has what's called the home rule. And then what that is that the state has almost 100 different municipalities or localities, 70 of which require their own sales tax filings. So that becomes a major burden. So for businesses that are selling, into the state of Colorado, for example, a state like Louisiana has parishes that have to be contended with. So the compliance of that is not simply a state filing, even with county and city taxes imposed on it. It could be multiple filings that have to be done even within one state.
And with that, Alan, I think we're going to end it. I hope you enjoyed it. We're willing to speak with anyone who has additional questions or meet with you if you feel it would be beneficial. And we want to thank you all for tuning in.
Yeah, we'll also be sending out the slides and the recording to you. And again, thank you for listening today.